Good afternoon once again, and welcome to the continued educational webinar series by Algorithmic Traders Association. My name is Alex Kristoff. I'm the Director of Educational Programs with Algorithmic Traders Association. First of all, I'd like to note that all the series of webinars is intended mostly to novice traders, and therefore its contents may seem too basic to seasoned professionals. However, I hope that even they might find something interesting in our discussions. Today we discuss one of the most important problems of systematic trading, the problem of the appropriate choice of trading techniques to use in specific markets. At first sight, this problem looks very minor and not important, because especially in the modern world, where access to virtually any information is now very easy and straightforward, it seems like it's sufficient only to quickly Google around to find a bunch of trading methods which are reported to be successful in particular markets. However, as we all know that most of traders still lose money, otherwise the market itself would have been destroyed, maybe the quickest choice is not the best one. The key problem of choosing an appropriate trading technique is a common problem of choosing anything in a new domain. When we only start getting acquainted with anything new, be it a new skill, a new language, even a new country, or even a new city, we need to somehow adapt to this new environment. And therefore, we need to pick the right behavior in this new environment. With most of the everyday activities, the best choice is to adapt and copy the behavior of our neighbors. Thus, if you start to learn to draw, you copy the existing works of art and known drawing techniques. If you learn a new language, you copy typical phrases which help communicating with others. In a new city, you copy the typical behavior of its inhabitants. In all these cases, you can relatively quickly estimate the degree of your success. If you can draw a nice-looking picture, if you can understand and be understood by natives, and if you're able to find your way to the supermarket in a new country, then you have successfully adapted to the new environment. The key difference between these examples and trading is that, first of all, in these examples you don't risk money, and second, that in trading it takes much more time to estimate the degree of success. It's interesting that although there are many sources of information today about markets, trading, and everything associated with it, it's still hard to make a proper choice if you just make your first steps in it. The main problem is that it's very hard to get any reliable confirmation of success of any particular method or group of methods in a particular market. In everyday activities, you can choose almost any option, and it will work sooner or later. For example, if you want to learn a new language, the choice of the method mostly affects only the time spent on this enterprise. But if you strictly follow instructions, then most likely sooner or later you will get to where you want. In trading, only a small number of methods really lead to success, and information about them is available only in portions, frequently unordered and unclassified, and even worse, the same idea or method can be presented in different forms, thus making the right choice even more difficult. In most cases, the ultimate proof of the correctness of the choice is only personal experience. In this webinar, we will attempt to suggest a very general classification of trading techniques and methods, which supposedly will help better understanding new ideas. This means that when you read about a new, progressive, unprecedented, scientific, institutional, whatever you like, trading technique, you can immediately attribute it to a known class and therefore estimate the chances of it to really correspond to its declared properties. Thus, it simplifies the initial sieving of ideas, keeping only those which can really be used in your particular case. Initially, the amount of trading technique looks enormous. Indeed, a simple Google search for trading techniques or trading systems returns millions of results. And unfortunately, quite a good deal of their results feature a strong sales pitch. This sales pitch is the very factor which pushes publishers to design a new wrapping for the same product, quite like candies manufacturers. However, following a general classification and asking ourselves simple questions about the suggested method or strategy properties helps understanding that only a few types of trading techniques are indeed different. Thus, it's possible to get a realistic estimate of its suitability for your needs. We start building our classification with just two criteria. Each of them divides all types of trading techniques in only two classes. So, the first criterion on top level is whether a technique is discretionary or systematic. By discretionary, we assume anything that requires a human opinion to make actual trading decisions, and what cannot be or can hardly be quantified. It doesn't mean that discretionary traders place their trades randomly. In most cases, they base their judgment on various non-price and even non-numeric information. On the contrary, systematic trading is something based on statistics and therefore requires a formal description of the reasons to get into or out of a trade. In most cases, these formal descriptions can be translated into algorithms and therefore tested. The second top-level criterion which we use is whether a trading technique or method is of the buy side or sell side. It's important to remind at this point the difference between the terminology used in investment and in systematic trading. In investment, sell side is someone who makes a market research, and buy side is someone who purchases such research. In systematic trading, sell side provides liquidity to the market, and buy side consumes this liquidity. As we will see, this difference becomes crucial for the whole classification. Now, just using these two top-level criteria, we can build a comprehensive classification. We can see that in the domain of discretionary methods, sell side is represented with only one technique, while buy side is far more diverse. Discretionary buy side techniques can be classified into 5 major classes. Techniques of the first class are based on immediate price analysis, known as price action or tape reading. The second class represents techniques based on macroeconomics analysis or fundamental factors. These techniques are predominantly used by long-term investors, however, there are certain exceptions. Third class includes techniques exploiting market reaction to various news and broad sense. By news here, we understand all the non-market information which, however, affects liquidity in the market and therefore provokes certain price movements. The fourth class includes techniques based on technical analysis. Note that we classify them as discretionary and not systematic methods because, as you know, most of technical analysis indicators only generate signals which do not ensure consistent wins and therefore should be filtered. Such a filtration requires traders' discretion in most cases. And finally, included mostly only to make our classification complete, esoteric methods, something based on astrology, crystal balls, and similar stuff. You may wonder why we mention these techniques at all, but you would be surprised if you learned how many traders actually rely on these methods. Of course, we don't discuss their profitability. Now, in the systematic domain on the sell side, we can see a wider variety of classes of trading techniques. First of all, It is market making in various forms, the very domain which nowadays is probably the most science intensive. Close to it is the second class, arbitrage, which also requires today expensive infrastructure and advanced programming. And the third, vast and very popular class of sell-side systematic trading techniques is, of course, derivatives trading, which today uses the most advanced mathematics. This is the very domain where many scientists can really make a career in trading, although only working for an institution. Buy-side systematic trading techniques can mostly be classified into directional, investment, or buy and hold, and market neutral. Directional trading techniques is what most retail traders try to use. They all exploit direct price changes which exist in a certain time frame. Buy and hold techniques mostly use various money management methods, since it's less important when you actually add to the position, but mostly how much. And finally, market neutral techniques, among which using options for delta hedging is probably one of the most explanatory and simple examples. Now, with this classification in mind, we can narrow down the choice of trading techniques. In this webinar, we discussed only trading techniques suitable for individual traders, only because they are the greatest group of our attendees. Thus, we do not consider any trading technique which individual traders physically cannot use. Obviously, in this case, we should exclude from consideration all the sell-side techniques. For clarity's sake, I should note that there are some notable exceptions. I know at least one trader who was able to develop the whole infrastructure and traded arbitrage and spot forex with moderate success. However, one exception is unfortunately not sufficient to disprove the rule, even set aside the fact that he invested quite a considerable amount of money into this project. Therefore, we believe that individual traders work exclusively in the buy-side domain. Let's quickly revisit the definitions of buy-side and sell-side in systematic trading. A buy-side trader is the one who consumes the liquidity. As the result, he can only agree to prices offered by sell-side. One of the important mistakes here is confusing posting your own bids and asks with limit orders. In case we work in an exchange-based market, a limit order from an individual trader is always sent to the end of the queue of orders, and no other buy-side trader is able to prefer this order to any other. In other words, a limit order will be executed only after all orders preceding it in the queue will be executed. In an ECN, you can send a limit order, but it won't be seen by other price takers. And in case of OTC trading or trading with the market maker, it's obvious that no information about your limit orders will be available to other market participants. Thus, a buy-side trader is unable to post his own bids and offers and always pays the spread. On the contrary, a sell-side trader provides liquidity to the market. He posts new bids and offers, and his income is the spread itself. This is the reason why many buy-side traders, and not only retail traders, sometimes invite the sell side and believe that their income is a kind of holy grail. However, sell side is also prone to problems. In case they are unable to find two counterparties to make their spread, they may be left off with an open position. And this is something which is very uncomfortable for them, if not dangerous. Therefore, sell side doesn't use directional trading techniques, as all of them assume holding a position in hope that the price will change in their favor. Having said all that about sell side, it becomes more or less clear why an individual trader in most cases cannot be a sell side trader. Modern infrastructure required for successful sell-side trading features low latency, and although this is something available to an individual trader, its costs might be too high. Besides that, investments into the development of the programming part of the project are normally very significant, and unless the trader himself is an all-in-one mathematician, decent programmer, and very knowledgeable in market structure and microstructure, sell-side activity is definitely not for individual traders. Now we can revise our classification and leave only those classes of trading techniques which are available to individual traders. At this point, one interesting thing becomes apparent. No activity at the buy side, neither discretionary nor systematic, require use of advanced mathematical models. They are used only by sell side in market making, arbitrage, and derivatives trading. Therefore, if you meet a prospective trading technique which requires solving systems of differential equations or other things you don't understand, most likely this is simply not what you need. Let's now go further and try to build a more detailed classification of those trading techniques available to individual traders. For this purpose, we will use a number of metrics: holding period, risk-reward ratio, and an average trade value. As we will see, these three metrics, if combined together, provide for a number of combinations which exhaustively describe the peculiarity of each trading technique from psychological point of view. And even in to talk about systematic trading, psychology, unfortunately, plays an important role even here. So many good systems were thrown away only because traders were unable to follow them just because their typical behavior didn't meet their expectations or their psychology. We will also include certain key features which further classify trading techniques into subclasses. The main focus here is on expenses spent on the strategy or investments and into it, and return on these expenses or investments. By expenses or investments, we mean not only money, but also time and overall effort spent on a particular strategy. Therefore, the return on investment or return on efforts, expenses, is an important estimate because all people in general can be classified according to this metric into only two classes: those who accept snatching pennies out of a rail before a steamer on full tilt, and those who don't. Knowing both metrics and features, we are able to suggest the most appropriate markets for a particular trading technique. As you can see, we will be able not only to pick the most appropriate trading methods, but also suggest the most comfortable markets for a particular trading technique. Now, let's start with the first one from the discretionary domain, the tape reading or price action trading. The idea here is to place trades, basing trading decisions on order flow changes and exiting with the first signs of flow exhaustion. Now let's look at our metrics and features. Holding period. Holding period here is very brief, seconds to maximum minutes. And the ratio of risk to reward is very high. And the average trade is very low. The infrastructure required to perform this type of trading is very basic, very simple. The time investments, that is, how much time the very process requires, is very high. It is very time consuming. And eventually the return on investment in both senses, in money and time and effort, is very low. Macro trading, and here we also mention fundamental trading, opening positions based on macroeconomical data. So all economical indicators, corporate reports, earning reports, and so on, they all go into this category. Now, what about metrics? Holding period, typically it is between days and months. And the risk to reward ratio in this case is moderate to low. And the average trade ranges, let's say, between 1 and 10%. The range is very wide here, I understand, but it heavily depends on the very type of strategy that uses macro data. Again, the infrastructure required for this type of trading is very basic. Time investments are still high, not as high as in case of tape reading, of course, but nevertheless, to correctly place a trade, you need first to perform a correct market research, and therefore, this is something that does require time. Therefore, overall, the returns on investment or returns on effort are moderate. News trading, something that used to be extremely popular, especially among forex traders some 10 years ago. The idea is to open positions as a reaction to news releases or in anticipation of such a reaction that suppose price movements on large scale. Let's look at the metrics. The holding period is again seconds to minutes, something slightly longer than in case of tape reading. The risk to reward ratio is again high to moderate, and the average trade is also very low. The infrastructure normally is very basic. However, there is one important remark. Typically, a news trader requires a stable and very low latency data feed and news feed. And sometimes this is something that cannot be called basic infrastructure, at least because it requires some investments into buying these data. Investments in time are really low because you need to be in front of your computer only for a very brief period of time. And overall returns on investment or returns on efforts are moderate. Directional trading. This is something that is most popular among retail traders, not only retail traders. This means opening positions and waiting for the price to improve. And again, let's look at the metrics. The holding period varies in very, very wide range, seconds to weeks. The risk to reward normally is moderate to low, and the average trade is proportional to holding period. Maybe you have already noticed that in our previous examples, even from different trading techniques. Overall, the rule of thumb is the longer you stay in the market, the greater your average trade. The infrastructure required is, let's say, basic to advanced. Depends again on the frequency of your trades, on the quality of the data feed, and so on. The time investments are high, but these investments mostly are in research and development. And returns on investments, returns on efforts is moderate to high. Buy and hold. We accumulate a very, very long-term position based on premises of growing asset prices. So we believe that this asset or this group of assets will increase its price over time. Therefore, we only wait for good moments to increase our long-term position. Metrics. The holding period is weeks to years. The risk to reward is, let's say, high to moderate. And average trade, it is incorrect to speak about average trade here because buy and hold is not, let's say, trading in its pure form. Since we only add to position, add to position, add to position, it's better to speak about typical returns over time. So it doesn't mean 10% guaranteed or only 10% per year. This means that the actual figure will be the same power of magnitude as 10. Infrastructure required for buy and hold is of course very basic, and time investments are very moderate, and the return on investment is also moderate. And finally, market neutral. This basically means having multiple positions in the underlying derivatives. Mostly options are used for this purpose, and collecting passive income. So the holding period is days to weeks, sometimes even months. The risk-to-reward ratio is very low. However, the return is also very low. So the average trade is approximately 1 to 10 spreads. The infrastructure required for this purpose is advanced because it should allow access to multiple data feeds, to mix multiple instruments, and to present the information in the appropriate form. Time investments are, let's say, moderate because most of the time we just wait accumulating this passive income. And return on investment or return on efforts is really high. So, as you can see, all these features and metrics affect each other. And there is no combination of low risk reward, low time investments, and short holding period with high return on investment and large average trade. So a trader should find a balance that suits his psychology. Even in case he prefers systematical trading methods, psychology is something that at certain point may prevent him from following his own strategy. And as we can see here, there are different proportions between the factors that we have just observed. For example, it is inappropriate to say, I want to trade tape reading, for example. It is appropriate to say, I am ready to trade very short-term positions with high risk and low reward, and I am willing to dedicate all my time to it. In this case, indeed, you can say, I want to trade tape reading. And one important note on day trading now. Very frequently, day trading is supposed to be a trading technique. No, this is not a trading technique. It is simply a requirement to liquidate all positions by the closing bell of the exchange to exclude overnight risks and reduce required margin. And those that believe that day trading is the way to go always should bear in mind that developing a consistent intraday directional strategy is way more complicated than developing a directional strategy that holds positions overnight. Why? Well, this is one of the questions that is discussed within our special educational course that we offer for systematic traders. So the problem of proper choice of trading methods and their implementation in algorithms and codes is absolutely crucial for success in modern markets. And to help systematic traders find new trading ideas and to help investors get more acquainted with the systematic approach, we have developed this very special course, which includes both exhaustive market research and trading systems design. This research not only allows to create simple and yet consistent trading strategies, but it also features all the essential training in backtesting, optimization, and of course robustness assessment. We believe that this unparalleled course is so far the only educational program which explains where to find new trading ideas for your strategies and how to survive the greatest changes in the world markets which are underway now. So at this point, I would like to say thank you, and for those who want to learn more about this educational program, I will proceed a few moments later. For those who came only to listen about the classification of trading techniques, let me repeat thank you and wish you a good night, and remind you not to forget to subscribe to our YouTube channel and to regularly refresh information about our upcoming webinars. And again, for those left here in the webinar, let me continue with the very brief outline of this educational program. So the program itself consists mainly in three parts. The first part is all about market analysis. We analyze the markets, we analyze the reasons that cause price movements and so on. The second stage is all about the algorithm design, backtesting and optimization. And finally, the ultimate goal is to learn how to create robust portfolios and diversify your risks using multiple strategies and multiple markets. So within the first stage, we first treat a market as a superposition of different actions by different market participants. So this is the cornerstone of this approach to market analysis, and therefore this opens the door to numerous strategies combined in portfolios. Next, we learn how to identify ideas that really work in the market. And finally, how to transform these ideas into codes. Second stage, focused mostly on actual development of the algorithms of programming codes. So we also discuss how to properly run backtest to avoid a lot of mistakes and to do it almost flawless. And also we discuss optimization mostly as a research, as a means of research rather than just finding a unique set of parameters that fits the past performance, the curve, to the historical data. So we also learn how to avoid mistakes of over-optimization or curve fitting. And finally, we learn how to create robust portfolios of both strategies and markets, how to manage operational and systemic risks, and how to identify the moment when to switch off a system, because sometimes this becomes the most important knowledge in your life. About the technical terms, the course normally takes about 3 months, and it consists of weekly live online classes. and we work in small groups of no more than 3 students. But please note that between these weekly classes, students are supposed to do a lot of work at home. Of course, under my guidance, but nevertheless, this course is not an entertainment. It really requires a lot of work to really become proficient in this domain. Let's say basic mathematical background is required. This means that if you ever graduated from primary school, that most likely you will be okay to take this course. About basic programming skills, I worked even with students with 0 programming experience, but since most of the examples of the sample strategies that we develop are written in easy language, the language of TradeStation and multi-charts. Practice shows that it is possible to train a student within a week's time to start coding in this language. So, I've been asked many times to somehow illustrate the process of learning, or what we do in the class. So how a student can learn to develop trading strategies, and what it means to develop a trading strategy from a trading idea to a mature product. Before we proceed, I have to show you this risk warning and say that all the performance shown is only theoretical or hypothetical performance, and no representation is made that you will be able to achieve the same level of profits or losses as shown. So let's consider a simple example. One of the first strategies that we normally consider within the course is a strategy that trades the euro. It's a strategy that works on daily data and holds positions for a considerable time. The original code, which is developed in class under my guidance, looks like this. So I intentionally blurred it out so that no one could read it, but at least it provides an idea about the complexity of the code. As you can see, the initial idea in the algorithmic form is not complex at all. Now, the performance of such a strategy looks like this. So we can see that this strategy prototype indeed shows certain upside potential. However, in the present form, it is far from not only from being perfect, it is not possible to put it to production. Now, the student has to improve this strategy. And to improve this strategy doesn't mean only finding certain sets of parameters to the strategy. As you can see, in the first line, we can see only 2 inputs, only 2 parameters, so not much space for tweaking with them. And then the student works on this strategy and ends up with a code like this. As you can see, it's much more complex. And it is more complex simply because the student added a lot of special conditions that better describe the pattern of behavior, the situation, or the trading idea itself. And therefore, the performance of the final version now looks like this. So in this form, it is absolutely suitable to put in production, especially that eventually we mix a number of different strategies in different markets, and we are able even to get rid of unpleasant drawdowns like what you can see in this chart. So this is what I wanted to say about the educational course, and I'd like to say again thank you for your patience and for